Live from New York City this morning. Good morning, good morning. What a week we've got coming up for you. The Federal Reserve on Wednesday and a payrolls report this coming Friday. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open with Jonathan Ferro.
Live from New York, we begin with the big issue, looking ahead to the Fed's next move.
The foregone conclusion, the Fed goes 50 basis points.
The widely expected 50 basis point hike.
They have no choice but to hike 50 basis points.
People are heavily fixated on where rates are going to be.
But it's the longer term that's getting harder.
The path to a soft landing for the Fed is narrowing.
The Fed is in warp speed in terms of trying to get to neutral.
2.25, 2.5, maybe a bit higher.
And I don't think anybody knows what the neutral rate is.
As for whether the Fed put is dead.
Oh, I think it's dead.
It's just in hibernation.
They'll signal more hawkishness and more rate hikes ahead.
The risk, I think, is maybe they don't slow down.
When you distort markets for this long, you have to pay the consequences, unfortunately.
At a May meeting, you're going to start to lay out more of the plan.
Joining us now, RB advisors Michael Kontopoulos, Zach Griffiths of Wells Fargo. Zach, first to you. Where is there scope for surprise this Wednesday? I keep asking that because everybody agrees we get 50 basis points. Where can we get a surprise from? What's your view?
Yeah, Jonathan, it does seem like everyone has coalesced around 50 basis points and an announcement of balance sheet runoff. We expect that will go into an effect in June. Perhaps it starts in May, but signaling by Fed Governor Brainerd, New York Fed President Williams indicated they prefer June. So as far as where the surprise could be, I think it would have to come down to Chairman Powell's press conference and whether or not he really indicates that 50 basis points at every meeting, at several meetings, what have you, that's going to be the key. Will they do 50 more than the twice that we expect? The market, I think, expects about 3 consecutive 50 basis point hikes. We're skeptical of that, but that's what we're going to be focused on for a potential surprise out of the Fed.
Michael, what's your take?
Yeah, I agree. I think the surprise has to be in the forward guidance and the rhetoric going forward. How hawkish are they going to be? How much are they going to, effectively admit that they're behind the curve and need to make up ground here on inflation? To me, I think that's the biggest wild card is just their acknowledgement that this is going to be a long, drawn-out process, or are they going to stick to the party line that they're going to get this and they're going to be able to achieve a soft landing? So I think it's in the forward guidance. I agree.
Michael, there's a feeling right now that the next 100 basis points is pretty boring. It's done. BlackRock told me on Friday that this Fed does not have the luxury of being data dependent. Do you expect to get any clarity beyond the next 100 basis points at this Fed meeting?
Well, I think the clarity that you may get, again, is the admission that they're well behind the curve. You look at the employment cost index, you look at owner's equivalent rent, you think about the demographics, what's going on in China. Clearly, transitory is long gone. And really it comes down to now, is the Fed going to own up to the mistakes of the past? And are they going to indicate that perhaps the terminal rate's much higher in order to be able to get inflation under control? And so I think, yes, the first 100 is clearly well telegraphed. We think they're going to go probably 50 in May, 50 in June, but the market already assumes that. The question is, what about later? What about later this year, right? How are they taking into account the more permanent factors of inflation? Are they taking it seriously finally? I think we could get some of those answers, and obviously that's what the market's going to be looking for.
And do they have a tougher choice, Zach? Do they have to choose at some point this year between capping inflation or supporting growth? Right now, they believe they don't have to make that choice because the growth, the data, as far as they're concerned, is still decent. This is what Priya Misra of TD had to say. I struggle with the notion that the economy can handle continued hikes beyond neutral and QT. People think that inflation could be sticky and that will not allow the Fed to slow down tightening. But I think the economy is not as resilient. Zach, what do you say back to that?
We think the consumer is still quite resilient, and to see these hikes that we expect over the next several months, and the economy should slow down a bit, but we think we continue growing around trend-like growth. We have year-over-year growth in 2022 at 2.8%. So I wouldn't even say that that's falling below trend, but on a quarterly basis, on a sequential basis, we do have it decelerating. So I think I'd say the consumer is more resilient. You do still have a lot of the stimulus of the past couple of years sitting on consumers' balance sheets. And so we think that gives the Fed the scope to really focus on getting inflation under control. And they've made it very clear that's priority number one, and nothing else is even close.
Big week ahead, not just the Fed on Wednesday, also payrolls on Friday. Bank of America coming out with a range of estimates, looking for an ISM close to 60, payrolls at 450, unemployment down to 3.5, a 50 basis point hike, and the start of QT. Mike McKee, you're going to be a busy man.
Yeah, and it looks like the Fed is going to be able to get going, at least rather quickly, as the panel points out. It's not a question of what, but what's next. We're not only pricing in 50 basis points for this meeting on Wednesday, we're pricing in 50 basis points for the next 3 meetings. And then you get to 10 moves by the end of the year, 11 moves by the first meeting in 2023. That would put us at or slightly above neutral if you accept the Fed's 2.5% neutral estimate. And that would be a rather quick pace of tightening, the quickest since 1994. And now I feel like a game show host because, as you pointed out, John, that's not all. We've got not only the Fed on Wednesday, but the refunding announcement. Treasury's going to start selling bonds without the Fed as the ultimate buyer. Who's going to buy it? How much are they going to sell? That's going to be a really important question for the bond market. Payrolls on Friday. As you mentioned, watch average hourly earnings. Do we see a slowdown? Do we start to see some wage pressure easing? The Aussies and the British are going to be making rate decisions as well. And that's going to affect the markets because as they take stimulus out of the markets, forgot the word, it's going to affect rates. And then the wild card, do we get a Russian oil embargo? That's going to be a really big question because then oil prices go up, inflation goes up. Last time we went 50 was 2000, in March of 2000, and here's what happened. You can see where the red circle is what happened. Inflation did come down, but we also had the tech bubble burst. So which came first, the chicken or the egg? And then you can see the recession that we entered into. Does the Fed send us into that kind of recession again?
My Bank of America just published, and they said something that's pretty interesting. We're talking about where there's scope for surprise. The bar right now is so high for the Fed through the next couple of meetings because we're looking at 50, 50, 50, and maybe even 50 again. Bank of America say this: it will be hard for the Fed to out-hawk the market. A non-committal Powell on a 75 basis point June hike risks a slightly dovish market outcome. Do you think, Mike, that's problematic? That if we get a dovish outcome, you get a loosening of financial conditions because the Fed is just kind of battling this market, which is just kind of out-hawk itself over the last few months?
Well, you could get a bit of one, but the market's already pushed up rates, and we're looking at 3% for the 10-year pretty soon here. The market's already pushed mortgage rates over 5%, and we're seeing a slowdown in housing. So it may not matter that too much to the Fed, but I suspect that Jay Powell's not going to want to commit to 75 at any particular time. Be interesting to see how much of a commitment he gives to 50 at the coming meetings.
True. Mike McKee, thank you, buddy, as always. Michael, I'd love you to respond to this. Michael Contopoulos, this line from B of A. It will be hard for the Fed to out-hawk the market. A non-committal Powell on 75 basis points in June risks a slightly dovish market outcome. Would you agree with that?
You know, I don't totally agree with that. I think if the Fed comes out with a 75 basis point, hike or announcement that they're going to do 75 basis points, I think there's plenty of room in the market for that to be priced in a higher rate environment. Listen, going to the previous question, Jonathan, about growth, I love Priya, ex-colleague of mine. She, no matter what she says, it shouldn't be taken lightly. But I think this economy can actually handle higher rates. You look at most of the leading economic indicators out there, they're pretty strong, continuing jobless claims, building permits, et cetera. But you have to think, the economy is much less sensitive to interest rates today than they were, 10, 12 years ago. Variable rate mortgages are non-existent. Cash on corporate and consumer balance sheets are incredibly high. Debt's been termed out at low levels. Interest coverage is exceptionally high. And so, I think that to your question on 75 basis points, the Fed may need to do that just to start making some sort of impact to consumption in the real economy. And, that likely leads to much higher rates and, the market pricing in more hawkishness. And I don't think it's done pricing in the amount the Fed can ultimately go.
Michael, I want to follow up on that one. You wrote in your notes about that transmission mechanism to the real economy from interest rates, and you said that had diminished versus the past. But is it the opposite when it comes to financial markets? Are these financial markets more connected to what is happening at the Federal Reserve than they were in the past also? And does that present very different threats this time around?
I think that's spot on, Jonathan. When I look at the transmission mechanism, so to speak, It could be through housing. We already seen the mortgage rates north of 5%, as Mike just mentioned, and it could be through bubble assets. Assets that are long duration, private equity, crypto, consumer services, discretionary, tech, obviously, right? All of these long duration assets that thrived off of QE. How many times, have people been on Bloomberg over the last 12 years talking about TINA? There is no alternative, the massive amount of liquidity in the system. That is all going away. What worked for the last 10 years because of virtually zero interest rates and a relatively low growth environment is probably not going to work where you have higher interest rates, higher liquidity, right? And a better growth environment. And so, yes, I think the transmission mechanism actually could be quite different. And rather than being on the real economy, instead, it's through maybe a deflation of risk assets that, really were in a bubble for the last 10, 12 years.
So, Zach, do you agree? Do you believe that we are breaking out into a very different market regime that perhaps we still haven't fully got our hands around?
I think it's an interesting point, and when you consider just how quickly the Fed needs to act, how high inflation is, all these other cross currents from a geopolitical standpoint, I think it is difficult to really have a very clear view of where we go from here, and we certainly take that point to heart as we forecast rates out here. We're using a much wider range of yield targets, and I think that is something that's going to be a story going forward as we get a better feel for exactly how much the Fed will do, how quickly, and how inflation responds. I think that's the key thing. If you still have inflation near our targets of 5.3% headline on PCE and 4.4% on core, can the Fed really take its foot off the gas with those levels? And we doubt it.
It raises big questions about the Fed put. We'll add to this conversation a little bit later. Mike and Zach are going to be sticking with us. Equity futures turn around again. They were positive by a third, a half of 1%. Then they were negative. Now they're unchanged, Taylor Riggs. I can't keep up.
John, and we're coming off of a really bad Friday. I don't know if you remember sort of the end of last week. We had a huge sort of bloodbath when it came to some of the big tech stocks. So that sort of sentiment, John, if you will, is continuing. Take a look at Amazon. You're off an additional 1.5%. Remember, you lost about $215 billion of market cap on Friday. That then was the second worst sort of one-day fall when you're thinking about all the companies and all the big sort of market cap that they have lost. So that theme, again, continues. I want to take a look at earnings, for example. Moody's, of course, here, one of those missing estimates, cutting the full year outlook, margin, cash flow. Another big theme here is we're thinking about cutting some of that forward guidance. Pfizer's another interesting one, John. You're off about 2.5%. You had some antiviral data when it came to COVID. That sort of missed the estimates. No statistically significant data coming out of that. And then finally, take a look at Activision. Of course, we've been following the Berkshire Hathaway annual meeting. Warren Buffett, of course, coming out and saying that he did indeed sort of was buying that stock ahead of that merger announcement with Microsoft. So shares there are getting a little bit of a boost.
Taylor, thank you. Lucky to have Taylor with us through to the opening bound this morning. Coming up, China's COVID-0 policy taking a toll in a big way on its economy.
Nobody can sort of walk away from China. China cannot be replaced. But at the same time, the policy that China's driving is so uncertain. The predictability of China is all of a sudden out of the window.
Lockdowns there straining global supply chains. That conversation up next.
Nobody can sort of walk away from China. China cannot be replaced. But at the same time, the policy that China's driving is so uncertain. The predictability of China is all of a sudden out of the window. We see already now members reshifting to source from other countries because they don't know if there's going to be another lockdown. The data set is very grim.
Said about right. It was absolutely terrible, the data from China going into the weekend. The stringent lockdowns clearly taken a massive toll on the economy. The PMIs plunging to their worst level since February 2020, with suppliers facing massive delivery delays. Joining us now is Damien Sassower of Bloomberg Intelligence. Damien, we can go through it together. 42 on a composite. This is the PMI. Manufacturing at 47, non-manufacturing at 41. It's pretty dreadful stuff, isn't it?
Yeah, the services figure. I mean, my goodness. But yeah, I mean, this is the worst we've seen since the height of the pandemic. And look, we expected as much. What's interesting beneath the data China. Exports, new orders, all incredibly weak. So demand is off the record. It's just off the record in China. But really, the interesting point here is construction activity. You know how Beijing is focused on infrastructure spending to kind of fuel that, 5.5% GDP growth target. It ain't going to happen with this type of number. I think we had 52.7 in construction activity. And if you look at the CACtion, which, is more small and medium enterprises in China, exceptionally weak. So across the board weakness. And again, we were calling for a little bit weaker. So maybe there was a little bit of padding to the statistics, so to speak, if you listen to Leland Miller. But for all intents and purposes, this was just a very bad print, and it's not getting any better. I mean, Shanghai was supposed to be on lockdown for 5 days. We're now 1 month in, Jonathan.
We've got to talk about Russia a little bit later this week. We'll save that for later this week.
Oh, God.
Any reason to believe that China blinks anytime soon on this zero COVID strategy?
Absolutely not. I don't see any. I mean, look, all indications point to the fact that they are not going to be providing direct support to households. They have not addressed the property sector. Yes, they said they're going to kind of spend on infrastructure. They're going to try and support growth. Yes, they're going to try and alleviate some of the tension in big technology. But at the end of the day, without direct support to households, I don't know how demand's going to come back online, Jonathan.
Damien, great to catch up with you, buddy. As always, looking forward to later in the week to talk Russia. This is the situation at the moment then. First 20 minutes of this program, we've been talking about the Federal Reserve. We've been talking about China. Who blinks first? Big market correction, will the Fed blink? Big growth correction, will China blink? This is what Standard Chartered have to say. Will the FOMC blink? We don't think that's a possibility until later in Q3 22. Will China's policymakers abandon their COVID zero policy? We don't think that's possible until at least after the 20th Congress of the Chinese Communist Party, likely to be held in the fall. Back with us, Zach and Michael. Zach, your view on this. Will the Fed blink, given what's happened with markets? Will the Chinese policymaker blink, given what's happening with their economy?
We don't think the Fed will blink at this point. You'd probably need to see a much more substantial drop in equity prices and tightening in financial conditions. And I agree with the note you just read. I don't think China's going to blink anytime soon. And if you think about the 20th Party Congress, that's going to be another 5-6 months down the road. So we think that's an appropriate time frame to consider where China won't blink and even the Fed won't blink for different reasons.
Michael, do you agree?
Generally speaking, I agree, Jonathan. In terms of the FOMC, I think what they're going to be mostly looking at are credit spreads. I don't think they really care, quite frankly, about tech and some of the bubble assets that I mentioned earlier. What they really care about is credit spreads and what's happening there and the transmission mechanism from credit to the real economy. Remember in 2018, when the Fed blinked, they weren't fighting inflation, right? And they had already gone through a hiking cycle. So they had arguably passed the neutral rate already. That's a very different situation from what you have today. So we think it's quite some time, unless credit markets push back really, really meaningfully. In terms of China, I think that's spot on. They have to wait, but when they go, they're likely to go pretty hard.
And Michael, I know you're careful with your words. You said credit spreads. Spreads have been contained, but total return in investment grade, for instance, it's been pretty ugly. Can you run me through what matters and what does not matter?
Absolutely. So far this year, it's been exactly what you said, a rate story more than a credit risk story. I mean, you look at credit fundamentals, and they're actually quite solid. Leverage, particularly net leverage, has collapsed. You have huge amounts of cash on balance sheets, and earnings growth is pretty substantial. Interest coverage is at all-time highs. The ability to pay your debt, the coupon on your debt through earnings, that's at all-time highs as debt has been termed out at really attractive levels. And so from a credit risk perspective, which is the spread that you're earning, of course, things look reasonably good. Now they've widened a little bit, but that's because of the volatility in rates and the volatility in equity markets. And if credit investors don't like one thing, it's volatility. They want certainty of the payment of their coupon and ultimate payment of principal. But, given what we've seen on the equity side, credit spreads have remained very, very well behaved. It's really an interest rate story, and the interest rate is what's killing particularly long duration investment grade and other areas of the investment grade market. So we would much rather take credit risk here than interest rate risk.
Does that mean loans over, say, high-yield bonds? I caught up with Vishy Tripatura of Morgan Stanley, who had that view at the start of the year. He's now changed his view. Would you still be comfortable with that?
We've liked shorter maturity high yield. There's too much default risk priced into the front end of the high yield market. You're earning nearly 7% in that portion of the high yield market. So it's a very high carry. So the compensation is very, very good with low duration. And so low duration high yield, i.e. short maturity with a high coupon, we think is actually more attractive than floating rate. But we do like floating rate paper in general, particularly AAA CLOs, for example. We think there's great value in that area of the market.
Final word here, Zach, goes to you. How you think this Fed responds this Wednesday to what's been happening in this market?
50 basis point hike. We have the balance sheet announcement coming this week, but going into effect in June. And we think Chairman Powell will keep his foot on the gas as far as indicating that they are going to need to tighten policy. And maybe he hedges his bet a little bit with an emphasis on data dependence around inflation. But given our outlook for inflation remaining persistently well above their 2% flexible average target, we think they are going to mean business for this meeting and the next several meetings, and aren't going to blink unless we see a really material tightening of financial conditions outside of what they see as necessary to bring inflation down.
Just a massive week lined up. To the two of you, thank you. Zach Griffiths, Michael Kontopoulos, lining things up for the week ahead with the Fed on Wednesday and payrolls this coming Friday. Coming up in the morning calls and later, looking back to a NASDAQ which just posted its worst monthly decline, going all the way back to 2008. We'll be catching up with Alicia Levine of BNY Mellon to get her calls on this market, to lift the lid on the index and get you some sector price action. This is Bloomberg. Coming off the back of the biggest monthly decline on the S&P going back to 2020, on the Nasdaq 100 much worse. You've got to go all the way back to 2008. Kicking off May with futures just about positive, 0.1% on the S&P. On Nasdaq futures almost there too, up by almost 0.1%. That's the price action. Here are your morning calls. First up, Piper Sandler upgrading Comerica to overweight, seeing limited downside to consensus estimates. That stock is up by more than 2%. Wedbush removing Amazon from its best ideas list, pointing to numerous question marks following the company's quarterly results. The horse and the barn door and all of that good stuff. That stock is down 1.3%. Rosenblatt cutting its Apple price target to 168, expecting China headwinds to continue fueling supply disruptions. We're negative there, just about 0.25%. No drama there. Coming up, big tech recording its worst month since 2008. BNY Mellon's Alicia Levine telling investors to steer clear of the lockdown winners. We'll catch up with Alicia next. Your opening bout just around the corner. 24 seconds away from the opening bout this morning. Good morning. Leaving April behind, it was brutal. Let's kick off May. Futures unchanged on the S&P. On the Nasdaq 100, we're negative by around about 0.1% there. On the Russell too. Last month, the ugliest on the S&P going back to 2020. On the Nasdaq, as you know, going back to 2008. Let's the opening bout, switch on the board and get to the bond market. Equities down last month, bonds down too. Yields higher. Higher again today by 3 basis points. We turn around here just a little bit. 296.90 on a US 10-year. In the FX market, euro dollar clinging, holding on to 105. Last month was ugly for the euro, 105.07 right now, negative 1/3% on that currency pair. And crude turning lower as well. We're down by a little more than 3% to 101.24. There's the opening bow then. Let's get you some movers. Here's Katie Lyons.
Well, I actually have a positive technology-oriented mover for you today, John, on the back of earnings. That would be On Semiconductor, delivering a first quarter beat and guidance for the second quarter that came in handily above analyst expectations. They say earnings going as higher as $1.32 in the current period. The street was down at 105, so a nice 2% lift for that stock there. But of course, things didn't go so well for Amazon with its disappointing outlook last week. Not looking great this morning either. After a 14% drop on Friday, the worst day for the stock since 2006, it's down another 1.4% this morning. Wedbush removing the stock from its best ideas list today. Also lower, Pfizer. Data over the weekend revealing that Paxlovid, which is its pill for treating COVID-19, failed to show benefit as a preventative therapy in a trial. So that stock's down 2% ahead of Pfizer's report tomorrow morning before the bell. And finally, in the airline world, we got 3 players involved here. JetBlue trying to buy Spirit Airlines, sweetening its offer, including a big breakup fee and divestiture commitments. Then Spirit saying, nope, we still prefer Frontier's bid for the company, which actually was lower, $2.9 billion. That stock down 7%, trading at $21.96, about $4 below Frontier's offer price of $25.83, John.
Kelly, awesome this morning. Appreciate it. Kelly Lyons there, just breaking down some of the movers. I'll break down some of the sector price action for you about 1 minute and 50 seconds in. We're positive on the S&P by 1/10. The leadership is pretty defensive at the moment. Utilities and staples. Utilities up 7/10, staples as well. At the bottom end of this market, the other performance coming from energy, down 0.6%. Consumer discretionary as well, down by about a third. Luke told Jim Paulson, looking at inflation and expecting it to continue to drive equities lower. He says the following: all the fears we have about a Fed policy mistake and recession are tied to concerns about inflation. And that's been reflected in the stock market this year. If inflation continues to rise, then the downside risk for stocks is double digits. And Taylor Riggs, let's face it, we're basically already there.
Yeah, I mean, certainly on some of the individual stocks, John. I mean, I'll just start broadly. You mentioned the NASDAQ 100 just had its worst month going back since 2008. Friday alone was the worst day since September of 2020. But you're right that underneath the surface, I mean, in April alone, Netflix is off 50%. We talk about the year. I think that number is closer to 60, 70%. Pretty much nowhere else to hide when you think about NVIDIA, Match, AMD, PayPal, Amazon, you name it, right? April really was a tough month as you're facing higher inflation and, of course, the rising interest rates that follow that. Change of the board, I think what's interesting, you've been doing this a lot on your program, is sort of the defensiveness of this nature. On record, you had staples outperforming discretionary in April, sort of the huge divergence that we continue to see. I would argue that perhaps maybe staples are those, of course, that can pass on some of those higher costs to consumers. And at least for now, consumers, they are doing okay. But I do wonder when you start to see a pivot, definitely more towards staples and away from some of those discretionary items, as typically budgets are fixed and you only have a finite amount of money to use. I think sort of quickly here, one thing we've been talking about, John, when we think about this is real wages. Yes, they are still negative. We've talked a lot about the big wage gains, but if inflation is still growing faster, then the wage gains are not enough to keep up with that.
Taylor, thank you. I just wanted to pick up on something Taylor said and fold in the work from Morgan Stanley and Mike Wilson on the defensives. This is what they said last week, quote, "We suggested the bear market was entering the phase when virtually nothing would work, even defensives." They added to that this morning, saying the market is currently so oversold, any good news could lead to a vicious bear market rally. But we want to make it clear this bear market is far from completed. The words of Mike Wilson and Morgan Stanley this morning. I think that quote on the air is wrong. But Morgan Stanley, Mike Wilson, just to be clear on all of that. I want to turn to Alicia Levine of BNY Mellon, recommending industries with pricing power and saying the following, pointing to high-quality defensive growth sectors such as energy, materials and industrials. Alicia joins us right now. Alicia, just to come to you and start with the index story last month. Down almost 9% in April on the S&P. Worst month going back to 2020. The NASDAQ 100 down 13%. Worst month back to going back to 2008. And your line here, avoid passive investing in 2022. Alicia, I think we have to start there. My audience has heard that year after year after year after year. Why do you believe it's true now?
So, good morning, Jonathan Ferro. And yes, April was the cruelest month, which is not normally the case in markets, as you know, but it was this year. Look, part of the reason that we say avoid passive investing is that there are going to be very few sectors that can come out of this inflation rise and the tamping down of inflation by the Fed, and they're just not large enough in the S&P to drive the index upward, right? So they can stabilize the index, but it's not sufficient. And if you look at what's happened with multiples just in the first 4 months of the year alone, the forward 12-month went from 21 times to 17 times, which is the 25-year average of the S&P. That was all done in 4 months, and it was mostly done on the back of growth stocks, not on the back of value stocks. And so you had a severe multiple compression in growth, and that's what drove the S&P lower, not so much the compression in the value. So, you know, we'd say here that you should really stick to sectors that can earn through inflation, that have sticky pricing power, and that we can see to the other side.
The breakdown, as you point out, just the weightings, I think, tell that story pretty easily. Energy makes up 4% of the S&P. Apple makes up 7% of the S&P. You can tell which is going to be more important. From a sector basis, let's build on that then, Alicia. What do you want to own? What do you want to avoid?
So we've been talking about owning CapEx here. And so it's not really sector specific, but it really is two things. It's the hard asset CapEx, because we do see a reshoring of supply chains to the U.S., not in its entirety, but enough to drive investment and enough to drive earnings in the companies who are the recipients of that. And also on the tech side, CapEx, because clearly digitization of pretty much every industry is happening and happening rather quickly, most notably in retail, actually. So those companies that are the recipients of CapEx, which we still think happen, will do very well. We just think you have to be very careful here, because what we saw during COVID, that it wasn't just certain household goods that over-earned, but it happened within the tech sector as well, as we saw last week in some of those earnings. And so when companies have over-earned, they're going to be punished by multiple compression until you weed all of that out of it to where you were in February 2020. The pain is not fully done yet in some of those sectors, we think. So you got to go with the names that really were somewhat pandemic losers here. And that means the reopening trade for now.
Alicia,
the interesting thing here, Jonathan.
Can I just jump in on defensives? Forgive me.
Yeah.
Morgan Stanley and Mike Wilson said that even defensives won't work in this market, and we saw evidence of that in the last couple of weeks. Do you push back against that in any way, shape or form?
Look, I push back because the money has to go somewhere, and we tell our clients to be invested, and so therefore we think the defensives will outperform the higher growth and the higher multiple names, and so we are invested there. So utilities and healthcare and staples, we have overweights to that, and we still like energy. Energy may have spiked on the hard asset on WTI, but we think that prices stay higher simply because the supply issues coming out of Europe are not going to be easily fixed. And supply takes a long time to get going here in the U.S. May happen eventually, but it's not going to be overnight.
Let's spend a bit more time on the banks as well. That's something that didn't work out in a way most people anticipated. Alicia, I've lost count of the amount of guests that came on this program at the start of the year and said, rate hike cycle is coming, get in front of the banks, get long those names, things are going to be good. Hasn't happened. Why hasn't it happened? And do you think it changes anytime soon?
Yeah, look, it hasn't happened because the fears of the cyclical slowdown were coming at the same time as we were expecting rate increases. So the fears of stagflation were right on top of the inflation ramp and the Fed hikes. So that's why it didn't happen on the bank side, because of the fear that the cyclical side was going to weaken the fundamentals there. Have they come down enough? Probably not yet. Probably not yet. I mean, the way we get out of this is that, inflation has to look like not just that it's peaking, that it's starting to come down on its own. So we don't want just peaking at a higher level, but starting to come down on its own without the Fed having to go past neutral. And we need earnings to hold up, earnings and margins. And if that holds up, then you can stabilize the markets. And sentiment is so universally negative, while starting this month, corporates are back in there buying back stock to the tune of billions, $5 billion a day. So we think probably in the short term you have a nice rally here, a nice tactical rally, but the fundamental side is not yet done. We're not done because inflation has to look like it's coming down a bit on its own.
Is that just a nice way of saying a bear market rally, a nice tactical rally, Alicia? Is that what that is?
I'm not gonna be led into that, Jonathan. I'll say this. We're sitting right at the intraday lows of February. A lot of damage has been done.
Yeah.
And that means best case scenario, it takes time to repair. And I don't think we're done discovering that some of these companies that are sort of hallmark companies out there had a bit of a pandemic bubble in parts of their business, not the entire business, like the classic pandemic winners out there, but parts of the businesses were probably pandemic winners, and that has to be wrung out of the system, as we saw last week. It just has to be wrung out. Doesn't mean the whole business it had over-earned, but part of it did, and we're not done with that yet. We're not done.
Well, Alicia, if we're not done with that, I just wonder, is it useful even looking at aggregate earnings through Q1? Is that even useful if we're not even done with the price correction? Because Deutsche Bank pointed this out. They said, despite concerns about cost pressures, margins remain elevated near record highs amidst robust sales growth. Margins for the medium company have, in fact, risen in Q1. It's hard to reconcile the earnings with the overall price action, but as you point out, this is about a correction of price and wringing out some really overinflated valuations over the last few years. So, Alicia, how instructive are the earnings of Q1?
So the earnings are very instructive, and it's one leg of the stool here. You need to have earnings hang in there. You need margins to hang in there, because without that, then we really do have a bear market. And the reason we're not actually calling for much further downside here is simply because we think the fundamentals actually are fairly good. And the real economy, despite the GDP print, which we know was artificially depressed because of the trade issue, also pointing to the overbuying on the goods sector, despite that, the economy still is coming in fairly well. You need the fundamentals. You cannot ignore it, because that's part of what gives you where the multiple is, right? The multiple is whether or not have we reached a place where margins have compressed enough and we can move forward, or are we going lower? We're at 17 times now for the S&P. We're at 21 times on the growth side. Does that go lower? That's really the question, not so much on the earnings side. It's the multiple side here.
Alicia, brilliant, as always. Come back soon. Don't leave it so long. We've got to do this again. Alicia Levine there of BNY Mellon. Thank you. Coming up, Speaker Pelosi making an unannounced visit to Ukraine.
We believe that we are visiting you to say thank you for your fight for freedom, that we are on a frontier of freedom, and that your fight is a fight for everyone.
That conversation up next.
We believe that we are visiting you to say thank you for your fight for freedom, that we are on a frontier of freedom, and that your fight is a fight for everyone. And so our commitment is to be there for you until the fight is done.
Speaker Pelosi sending a message of unity as the divide in Europe over Russian gas intensifies. The EU meeting in Brussels to settle their differences, with Hungary willing to veto an oil embargo and Germany looking for a compromise. Joining us now, Maria Tadeo in Brussels, Anne-Marie down in DC. Maria, first to you. How close are we, or far away are we from a deal over this kind of thing?
Well, Jonathan, you see how everything is changing here, because, of course, the biggest issue was Germany. But now the Germans say they are open to potentially dropping this veto. I spoke with the German economy minister, Robert Habeck, just a few minutes ago, and he said if we do it gradually, and when we talk about an embargo, we should be careful and say this is a light embargo, Jonathan, because it would not be overnight and it would be gradual from now until the end of the year. But he says Germany would not oppose this. The issue is now turning to Hungary and, of course, and Viktor Orban, who says, well, they don't see how this would put an end to the war. They say it would have a big detrimental impact on their economy. And remember, every decision here gets taken by unanimity. You have to agree the EU 27 as a bloc. But I would say one thing, Jonathan, when you look at the Hungarians, throughout this process, they have voted in favor of all of these sanctions. So there is a difference between what Viktor Orban says in public and what he does behind the scenes. And until now, this unity is holding. Whether it happens this week, tomorrow, by the end of the month, that is unclear. There is no specific deadline on it. This, we understand, may not even happen today. But you can see that the sense of direction now, it is clear to see this oil embargo taking place. We talk about oil, not gas, for the time being. I put that question to the German economy minister, and he was very careful to say this would just imply oil, not gas. The reason was pretty obvious. Germany still imports 35% of gas. Unplugging from that is very difficult.
And the latter is far more important than the former, as we know. AMH, something's developing stateside that perhaps isn't getting talked about enough. Just slowly, output in America is creeping higher, just short of 12 million barrels a day. Ed Morse's City earlier on today said we can get back to 13. Do you anticipate we will start to see results here? Because as someone reminded me, crude might have come back down, gas prices haven't really, and the price of flying, jet fuel, hasn't in a big way either. Can we make some changes here stateside anytime soon?
And diesel as well, and that's why you see this is such a big part of the inflation story, because diesel is what trucks run on, and of course that is really the heart and soul of how you get groceries and goods around America. What you are seeing, Jonathan, what the administration wanted to do is they made this ask to oil producers to pump more. And what they would talk about, I know Amos Hochstein talked about this with you, Tom and Lisa, about a 6-month gap. And that is why they wanted to tap the SPR to hopefully hold them over to when later in the year they do believe that there's going to be more investment and more production coming out of the United States. We also should note there is an OPEC meeting this week, Jonathan. So potentially we could see action from the OPEC Plus cartel. And potentially that will drive some direction in what we see from other major producers.
Anne-Marie, down in D.C. alongside Maria today in Brussels. As Trevor Noah, the comedian, said over the weekend at the White House Correspondents' Dinner to the president. So you've come into office and since then things are really looking up. Gas is up, rent is up, food is up, everything is up. To the two of you, thank you. Ed Morse's City weighing in on some of this, saying it's unlikely the EU will reach an agreement. Take a listen.
If Germany is not going to use its veto power in the EU, Hungary certainly will. So we don't think there's going to be an overall European Community agreement on not pulling in natural gas or oil from Russia. We don't think the Russians are going to pull back because income is better than no income.
Julian Lee joins us now from Bloomberg. Julian, if it's not Germany, it's Hungary. If it's not Hungary, it's Germany again. Any chance of a European-level deal on this kind of thing anytime soon?
I think it's looking very uncertain at the moment. I mean, we have seen the Hungarians repeatedly saying that they won't go along with sanctions, and yet every time they have done. I think energy, and at the moment we're looking only at oil and not gas, as you said, that may be a sticking point. But in some senses, you don't really need an EU-wide embargo. If Germany decides that it's going to stop buying and winds down its imports, if some of the other big importers of Russian oil do the same, it doesn't really matter whether that's done through the EU or not. What matters is who's buying.
Julian, you go a little bit deeper as well, beyond just Russian crude. We took a little snippet of your recent column, and this was the quote we pulled out. Putting restrictions on Russian crude is one thing. Trying to stop the sale of Russian refined products is much more complicated, in part because it's not clear what can or should be included. Julian, can you just speak a little bit more on that? Because I'm not sure how familiar many of us are with that particular story.
Yeah, I mean, it's very easy to see what is Russian crude and what isn't. There are, there's one perhaps slightly ambiguous grade that's 90% from Kazakhstan and 10% from Russia, but I think that's very likely to be left out of any sanctions, and quite rightly too. But when you get to refined products, it gets a lot more difficult, particularly if you start to think about this big movement that we're seeing of Russian crude going to refineries in Asia, particularly in India, because those refineries then re-export a significant proportion of the products they make. So is a cargo of diesel that is made in India or processed in an Indian refinery that is running Russian crude, does that diesel then fall under sanctions or doesn't it? Is it Russian diesel or is it Indian diesel? And that, I think, becomes a much more complicated question. My suspicion is that those kinds of products will probably be left out, because if you include those, then maybe you start creating real problems in terms of diesel shortages.
Julian, wonderful to get your thoughts and some clarity on a really important topic, as we've gotten used to in Europe for a long, long time. They talk for a long time and then end up with a fudge and a suboptimal outcome. And to Julian's point, maybe that's what this ends up like as well. Julian Lee there of Bloomberg Intelligence and Bloomberg Opinion. Coming up, the market-moving events you need to be watching. That'll be next in our trading diary. From New York City this morning, good morning. This is Bloomberg. 26 minutes into the session this Monday morning. Good morning. Kicking off the month of May with equities just about positive by 1/10% on the S&P and the Nasdaq up by 0.5%. That's the price action. Here's your trading diary. At the top of the hour, the ISM manufacturing number, US factory orders and an RBA rate decision on Tuesday, a rate decision from the Fed and a Powell news conference on Wednesday, the Bank of England with its own rate decision this coming Thursday, and finally, we round out the week with a payrolls report in America. The estimate so far, moving target, of course, in our survey, the median estimate 391,000 from a previous number of 431. Big week ahead. Thank you for choosing Bloomberg TV. For our audience worldwide, this was the countdown to the open. This is Bloomberg.